Hello and welcome. Today, we're going to do something a little different. We're going to take a single, pretty complex-looking financial chart and we're going to decode it, piece by piece, to really understand the story it's telling and the prediction it's trying to make. It's time to decode this thing.
Okay, so here it is. This is a 4-hour price chart for gold. And I know what you're thinking. At first glance, it just looks like a chaotic jumble of lines and colors, right? But what if I told you that to the analyst who made this, it's actually a map pointing towards a very specific destination for the price?
So, that's the big question, isn't it? What is this map predicting? And maybe more importantly, how did they even come up with that? Let's peel back the layers and see how it works.
All right, first things first. Before we can understand the map, we've got to learn the language it's written in. And that language is made up of these things called candlesticks. Let's zoom right in on these little green and red bars. They might look totally random, but trust me, each and every one of them tells a very specific story about what happened to the price of gold during a specific 4-hour window. The easiest way to think about it is like this. Every single candle is a round in a constant battle between buyers and sellers. If you see a green candle, it means the buyers were in control. They pushed the price up in those 4 hours. A red candle? Well, that means the sellers won that round and the price went down. And that's the fundamental pulse of the market.
Okay, so we've got the basics down. Now, let's add the first layer the trader drew right on top of it all. The key levels that create a kind of playing field for the price.
So, see those two big red lines sloping up? The price looks like it's just bouncing between them, almost like a ball in a hallway, right? Well, that is no accident. The analyst drew those lines to reveal the hidden structure of the price's movement.
They're called trend lines, and they create a channel. The easiest way to think about it is this. The bottom line acts like a floor. It supports the price and tends to stop it from falling. The top line, that's the ceiling, or resistance, that the price struggles to break through. All right, on to the next layer of our map. See these horizontal lines? The ones with the percentages like 23.6, 38.2, and 50? This is another really cool tool the analyst is using to guess where the price might decide to turn around.
It's called Fibonacci retracement, which sounds super complicated, I know, but the idea is actually pretty simple. See, after a big move, the price often pulls back part of the way before it continues on its path. These Fibonacci levels are just common, well-known areas where that pullback might stop and reverse.
Now for our little puzzle here, the analyst is laser-focused on one specific line, that 38.2% level. Keep that number in your back pocket. It's a huge clue.
Okay, so we've got the price story and we've got the key levels. But there's still one more piece of the puzzle on this chart. We need to know if this trend has enough gas in the tank to keep going. We need to check the momentum.
Okay, now I want you to look at the very bottom of the chart. That separate little graph down there, that's not price. It's measuring something completely different. It's all about market momentum.
It's called the MACD indicator, and you can pretty much think of it like a speedometer for the price trend. It helps the analyst see if the trend is speeding up, if it's running out of steam, or if it's maybe about to change direction altogether.
All right, we've looked at all the individual clues. This is the fun part. Let's put it all together and see where X marks the spot. So here's the deal. The analyst spots a potential buying opportunity because 3 different clues are all pointing to the same spot. First, the price is heading down towards that trendline floor we talked about. Second, that floor lines up almost perfectly with that key 38.2% Fibonacci level. And third, if you just look to the left on the chart, you can see this is an area where buyers have stepped in before. You know, in the trading world, this is kind of the holy grail. It's a concept called confluence. It's when different independent tools all start screaming the same thing. And that dramatically increases the probability that you might be right.
And all that evidence, that confluence, that big X on our treasure map, it all points to a very specific zone. The analyst is betting that buyers are going to show up somewhere between 45.38 and 45.15.
And there it is, that blue box. That's the whole point of the chart. Everything we just talked about, the trend lines, the Fibonacci level, the past price action, it all comes together right there. That's the analyst's high probability buy zone. So, does this mean gold is guaranteed to shoot up from here? Well, not so fast. This is where we have to separate a good analysis from what actually happens in the real world.
Look, if you take away one thing from all this, let it be this. Technical analysis is not a crystal ball. It doesn't predict the future with certainty. It's all about playing the odds. It's about finding situations where the probability is stacked in your favor. This chart is a great example of a high probability setup, but it is not a guarantee. And that leaves us with the most important question any real trader has to ask. The entire map is designed to find this perfect entry. But what if it's wrong? What happens if that floor just gives way and the price keeps on falling? Having a plan for that scenario, well, that's what separates a cool-looking chart from an actual professional trading strategy.